three which are more commonly used. There is the relief from royalty. The meme approach is the way we call it, which is the multi-period excess earning approach, and the incremental cash flow approach. Now, out of this, I'm sure relief from royalty is something that we've all heard of, even if we've not done intangible asset valuations. The reason is that conceptually, it is the easiest to understand, and practically, it's the easiest to apply if you look at it in one way, but that can be garbage in, garbage out. So let me just fundamentally explain. It essentially means the steps are you determine a royalty rate, you multiply it with the valuation base. So it could be a royalty rate, which is a percentage of revenue. So you sort of isolate the revenues attributable or that may flow in from an intangible asset and apply a royalty rate. Very simple, subtract taxes, and you do a present value, and you're done. But the most critical point is what royalty rate? Obviously the easiest inclination is to just put your hand in the air and say 5%, because it sounds good. And that is where the trick of using this approach is. It's important to look for pitfalls. Now, how are royalty rates determined? Number of ways. One is, again, what's happened in the market before. And there are various databases which say that, which give data for the royalties that have been charged, that have been agreed upon between two market participants in a particular transaction. But the hidden things can be that, that particular royalty rate could be, may not be a standalone one. There could be an upfront payment that you and I may have agreed upon, and then a royalty rate. And then if I use it to use the same royalty rate in to value another transaction, I could be going completely wrong in my assessment. So, there are lots of, that's the reason this approach needs to be applied with great caution, and never in my experience, unless you really have no choice, for the key intangible asset of a business. And preferably in tandem with another approach, so that again it is used as a reference check and not on a standalone basis. This is what is preferred by globally accepted by valuers for intangible assets, mostly for accounting purposes and increasingly for tax purposes as well. It's accepted globally by auditors, and that is the excess earnings approach. It's complicated, and I'll try and see for those of us who've not been associated with it before to try and simplify it. Essentially, if you see this, a little web on the left-hand side, this just shows that a business can potentially have a plethora of intangible assets, and including the tangible ones. So of course here you have on the right-hand side says that there are the tangible assets, and which are the fixed assets, your property, plant, and equipment, your working capital, and then there could be other intangible assets, right, trade name, etc. And then there could be a leading intangible asset in any business. Now, if you're unlucky, you'll be valuing a business that has two leading intangible assets, and then that'll be a tricky problem to solve. But let's look at a simple business that has just say the customers as the key assets, or an FMCG, let's say the brand is the key asset. So in that case, in the FMCG business, if I'm valuing the brand, first I need to look at what are the other intangible assets that the FMCG business has. It could be the distribution network. It could be the underlying technology, and so on and so forth. This I've just sort of explained what are the steps. The first step is deriving the cash flow which is attributable to the subject intangible assets, similar to the relief from royalty method, but there it's mostly the revenue, and as long as we have the revenue story right, we are sorted. But here we have to go right down to what is the EBITDA or the EBIT or the net profit, if you like, that can be attributable to, say, a product or a technology. And then there is this concept of contributory asset charges, which is what is unique to this approach and this whole intangible asset exercise. We subtract the expenses, the tax expenses, and come up with future cash flows which can be discounted. The first step, if I can, so you may have a business plan, right or wrong. Of course, go into assessment of whether that business plan makes sense or not. But because we are valuing a product or a customer or a bunch of products or a bunch of customers, that business plan needs to be split so that, let's say, if you're making 100 rupees as revenue, you can figure out, is all 100 attributable to the technology that I have? Or is it that 50 is coming from the this A technology and 40 is coming from B technology? So that both can be valued separately. And there are reasons to do that. Now, the important question is, can an intangible asset generate the same revenue on a standalone basis? So if you were to buy, if I have a brand where the revenue is 100 crores and I sell you the brand, will you start making 100 crores just by owning the brand? No. The reason is, which I discussed earlier, is because there are lots of other tangible and intangible assets that go into making that revenue of 100 crores. And that's where the concept of contributory asset charges comes in. So for instance here, in an intangible asset, there could be the workforce, the land and building, other intangible asset, etc. So typically in a meme exercise, we have to arrive at what is the value of all these other assets, so that we can understand that what are the potential charges that I, who owns just the brand, will need to pay to you who owns the land and building, you who own the machinery, you who own the networking capital, you own the workforce. Because on a standalone basis, my brand alone cannot produce 100 crores. The other methods that are used are the incremental cash flow method, which is again that what is the incremental revenue or the cost savings that can be attributed to a particular intangible asset, and just discount that cash flow. Now here, again, it's very simple to say that you have a company A's paper which sells for 10 rupees and a company B's paper which sells for 12 rupees, so the difference in the revenue is 2. But again, do we have enough data to see consistently companies B's paper has been selling at 12 rupees, or we just picked up a data and point? So again, theoretically it sounds good, but practically difficult to, maybe difficult to sort of implement and adopt. With or without method, I personally find it a very practical method where again, it's not so hard to apply and you do get data for it. Again, a lot of it judgmental. This is essentially to say that how can a business be run with the intangible asset that you're planning, that you're looking at valuing? So you have that one scenario there. And in another scenario, you have what will be the effect on the business if you did not have that particular intangible asset. So it could be an impact on revenue or costs or some other measure. And then we do a present value differential of the two. Like I said, determination of useful life is a critical thing in these valuations, and can be a tricky business. It could also, the easiest thing to see is, okay, if you have an intangible asset where you have a contract which is a 3-year life, so obviously you cannot take a life more than that. But the tougher things, the assessment of useful life comes in when you have a brand. Because again, companies are very touchy about a brand. It's always been there, it'll always be there. But again, what is the competitive positioning of the brand? How has the brand been growing in the recent years? Does it really merit what is indefinite life? Indefinite life, again, is something that auditors look at. They cringe when they see indefinite life because that has amortization implications. So typically, it's only trademarks, some trademarks and perpetual licenses, but all other intangible assets willy-nilly do have a finite life, in the sense it's very difficult to substantiate that they have an infinite life and hence huge value. Last, I'll just sort of take you through this ratchet which just briefly discusses the other single most important part, the discount rate. Rajan, of course, alluded to the WACC, and we're all familiar with it. But how does WACC compare with the discount rate that can be reasonably explained to value a particular intangible asset? Essentially, if you look at it, because a business is a sum of all the tangible and intangible assets, by corollary, that means that the WACC should be equal to an average or a weighted average, if you will, of all the tangible and intangible assets of that particular business. And this is like a reasonability check. If this check, once you do the intangible asset, ties in, means that you've been pretty correct or as correct as can be in the intangible asset valuations. So typically things like cash, inventory, receivables, if your receivables are genuine, will have lower discount rate associated, lower than the WACC of the business. Why? Because most of these can be funded mostly by debt, which has lower cost associated with it. And the more nebulous the intangible asset, like customer relationships or the license, the riskier the intangible asset, higher the discount rate that you could discount. What can go wrong, to conclude? Asset identification can go wrong. You could say, oh, this business just has the brand and the equipment and nothing else, which means what? All the value of the 100 crores that the business is making, but for a little bit of plant and machinery, will be attributed to the brand. Or brand ki kitni value hai? 5,000 crore. Because forgetting that there are other intangible assets. You could have a distribution network, which takes years to build. You could have a technology. Again, double counting of cash flows, discount rates, we've gone, I think most of these I've covered. Contributory asset charges are this, the key focus area if you're using the income approach for, and of course for now, just before you go in for lunch, you have a little entrance test for intangible asset valuations. We'll just pass the papers, and only those of us who clear it will be allowed lunch. But, well, thank you so much. Appreciate your attention.
This trivial question, in one of the initial slides, you mentioned interest-bearing debt. And you stood, so was there any specific reason to specify interest-bearing? I mean, one of the initial slides where you had enterprise values and the graphical thing.
Yeah, when we're trying to work out the WACC, we have to take cognizance of the debt which has been provided. Now, typically, you may have a situation, say, where you may have artificially low cost of debt. So when we're determining the WACC or the total, we're determining the cost of the cost of capital, basically, or for the capital employed, we do need to adjust it to the market rate because of the differential over here. So that was the reason for that.
Okay. Now the main question I wanted to ask was, even at the risk of making a very wide, broad sweeping generalization, we noticed that merger acquisition objectives are less often fulfilled than they are. Okay, a lot of this could be integration issues and things like that. But if we were to focus purely on valuation issues, would you like to point out, as an industry as a whole, do we tend to overvalue when we're acquiring? And if so, what are the pitfalls? I mean, some we've seen are estimation of risk, and even estimation of risk, one is, probability of incidence of risk, which probably is measured fairly accurately, but consequences of risks sometimes are not measured accurately. So do you want to elaborate on this and add some other things why, I mean, so many mergers go wrong and we realize in hindsight that we have a serious valuation problem?
What I've seen, one of the fundamental things, other than of course assessing that the projections are fine, but that's numerical in some ways. Strategically, I think and while it again boils down to the economic benefit, but the single point I feel that is critical is synergies. Now, you expect as an acquirer, if you already Yeah, no, it is, no, it is important because at times you could have cash flows which have synergies included in it. So that's one thing. The other thing, if you look at it from a valuation point of view, again, like I said, that's been said before, accepting the projected cash flows without complete analysis into a couple of things. A, how the company is behaving in the past. You know, how's the growth rate been? What is the market like? Are you have a situation where revenue growth consistently year on year is much higher than what the industry is talking about? You know, we've had situations where the EBITDA margins have been forever maintained at 45%. Now that is not sustainable. It may happen in 2-3 years. Your high growth may happen, you know, if you look at it hopefully in 2-3 years. But on a normal basis, on a sustainable basis, that is where the terminal value part that came in valuations. If you're expecting a stable business to have 80% of the value coming in from terminal value, which means that 5 saal baad jaake kahin paisa banega. But then the question to ask yourself in a high growth company, a new company, understandable. But then even there, are we taking enough of cushioning in our discount rate? So one of the two things has to happen. Either as a valuer or as a CXO, we have to arrive at a projected level of cash flows that we are all comfortable with, which have been, you know, simulated. They have gone through various iterations for the key assumptions. So, you know, you can be sure, like 50% sure that this is going to happen, or 80% sure that this is going to happen. Then measure whether the discount rate that is being used to discount those cash flows, is it apples to apples? Because we don't want undercounting or double counting. What I'm trying to say is that if we feel that revenues will grow from 100 to 150 in a year, which is a, you know, 50% growth. Now it's possible, maybe the industry is growing, maybe the base is too small, so you have greater potential to go, but there could be also strategic risk associated with that. In that case, the valuer needs to decide, should I discount it at 12%? Using the CAPM method, yes, but because of the uncertainty, should I bring the cash flows down or should I take the WACC up to make sure that at least I'm following a certain methodology, at the same time there's a reasonableness. And the other thing is, a lot of times, you know, it's been done, like we've noticed in a lot of deals, that it's been done on a market approach basis. 2 का multiple, 3 का multiple, और DCF करना है सिर्फ RBI के लिए, तो वो back derive हो जाएगा number. But then the point is, then coming back to this, I think using more than one approach, and at least as deal makers and valuers being true to ourselves that really what is the economic potential. We may structure the deal accordingly. So I think these are do you want to add something, Rajan?
See, again, another thing which you got to keep in mind is the valuations also are at a particular point of time, and they do get influenced or biased by the motives of the buyer or the seller. You can have typically a different situation or a value being ascribed by someone when it gets into a bidding situation vis-a-vis a strategic talk kind of a situation, and people may ascribe a higher value taking cognizance of higher synergistic benefits. Second thing is what times at which we are valuing. It can make a lot of difference. 2008-9 were fantastic years. You had cheaper cost of capital available to you, so you could you could ascribe a higher value because of that. You could afford it. Now in a downturn, when the interest costs are as high as 14%, can you really offer those kind of prices? So and obviously there are things like the euphoria around a deal which gets created at that point of time, a banker pushing you, and that's where the anchors or the biases may come into play when you're doing a deal. But if you do a careful scenario analysis, I think you can avoid some of those pitfalls.
About DCF valuation. Once you do a valuation, then we appoint different consultants, different marketing consultants. and they give different price projections. So the valuation could differ by using different assumptions. So we are always confused what is the right price projection and what is the right scientific basis for a DCF valuation. That is one question that I have. Secondly, valuation is more of science than an art, or probably more art than a science. Then why should there be any standards for valuation?
You want to?
I have these two questions in my mind right now.
Yeah,
Uh,
go ahead.
Yeah, regarding the DCF now, the key question which you asked is that you see again, if someone getting two different sets of projections, two different individuals could come to a different conclusion altogether. However, if two individuals are given the same set of projections and they do their job or they analyze the stuff in this thing, their opinion should to some extent converge, or they should not, unless until they got some very valid reasons that one person views a business in a particular way and the other person views it in a different way. You should not have that kind of a divergence. We've had situations where we work jointly with valuers on numerous M&A transactions, and joint valuers have been appointed. It is a norm over there that both the valuers, while they may carry out the job independently, the same set of numbers are given to them, because the basis of valuation or the projection can influence the whole thing.
And-
My question is not about valuation. My question is about price projections.
Yeah.
Valuation is just mathematical.
Yeah, actually,
What is the right basis of a price projection?
right.
You point Fertigon, they have different price projections. You point FMB, they have different price projections. So what's the right way?
Yeah, so if I may add, one cases where Rajan is alluding to, but there are also a lot of cases where, there are lots of valuations that are sponsored, that are sort of at the company law board's behest when, two shareholders, and this happens a lot of times where, one that shareholder that wants to buy and the other shareholder that wants to sell gives an independent valuer two different sets of projections. And that is why things like knowledge of the industry and understanding the business is very important for the valuer. Knowledge of the industry, again, if it's a pharmaceutical or an oil and gas industry, technically very challenging, etc., it's important for a valuer, whoever's assessing the valuation, to have an element of industry expertise so that you have a sense, is this industry really going to grow like this over the next 5 years? Are the margins in this industry possible? The second thing is understanding the business, the particular business, which means that, okay, the industry might be doing very well, but how is this particular business competitively positioned? How has this particular business been performing in the past? So the historical analysis from a ratio point of view is also very important. So that is why as valuers, when we look at projections that clients give us, while they are obviously the business experts, but we do come as independents and challenge some of those things. Either it could be on industry future data, it could be on the historical basis, it could be possible that the company just doesn't have the resources and it'll take time for the resources or that plant to be built up, और आप पहले ही revenue दिखा रहे हैं दूसरे साल से. So, those are the few benchmarks broadly that are used by prudent valuers to really assess, are these projections too optimistic or too pessimistic, depending on the bias that a buyer or the seller may have. So that is why a DCF or a valuation is not a simple arithmetic exercise, which can actually happen in an hour if you give an analyst an Excel sheet. That is why more analysis, and again, the trick is not to get lost in the analysis, which is where experience comes in.
Yeah, coming on to the second question. Again, it's a question of I think let's go a bit historically on whether there are standards or not. Till 91, we had the CCI kind of a situation where the controller of capital issue prescribed a methodology that this is the way IPOs and others should be prescribed. After that, they left it to the market. let the market determine the price. And in a lot of developed economies, it is that like UK and all that, it's a free market, so let the market participation is there. Now developing of the standards, the standardization of approaches and the methodologies is crucial to any this thing. It's something like what I said, if RBI prescribes that you do only DCF. Now, I don't think that that's the right way of prescribing it, that is the approach which should be followed. It may not be applicable across sectors or across industries. So what you can lay out are the broad frameworks or the broad methodologies. There are 3 methodologies at the end of it. And taking cognizance of the purpose and the relevance of the technique, that is where you got to apply that, and that is where uniformity is also required in terms of that the approach across geographies or countries is inconsistent, or someone is not following a different approach altogether for valuing an asset.
Simply put, framework is important for having some method in the chaos, and something which is accepted by, let's say, a larger pool of valuers or CXOs in terms of basics. It's important. Otherwise, I could be talking French and you would be talking English. So framework is important, and that's where the science of it comes in, because a framework is developed again on academic theories, and yes, colored with practice. But art is there because it can't be applied blindly, because each fact pattern of each case is different.
Thank you, Ms. Vandana. Thank you, Mr. Rajan. Here we are taking a lunch break. We will try to reassemble here 2:15. Please. Please join us for the.
Please take your seats. So I'm starting with the topic valuation in Indian regulatory environment. How I have structured the presentation is into 4 parts. Overview of valuations, that we already have a fair idea by now. Indian regulatory environment, that is the core topic. Taking it to the registered valuer, which is very hot these days. And then some of the tricky issues. When I was also sitting, there were certain questions that were coming, how to do this valuation, how to do that valuation. So I would like any of the questions, if you can just ask, we'll try to address that. I'm starting from the overview of valuation. So this we have understood that valuation is an economic concept, it's an estimate, and it is depending on certain things, like there will be certain assumptions, there will be certain limiting conditions, and there has to be data available on the valuation date. So these all bold points play a very crucial role in determining the valuation of any entity, any business. If you go through this slide, then valuation and the business and the country follow the law of economics. So there were questions that when we are making projections, then can it be 10, 20, 30, 40, 50? Or it has to be 10, 20, 30. We have to see the industry, like sugar industry, you take an example. It operates for a part of the year. So such kind of scenario is not possible. Second thing, apart from industry, is that what is the stage of the business? So whether the stage of the business is a startup, whether the stage of the business is growth, whether it is a distressed company, whether it is a declining company. So what is the stage of the business? That is very important, determining which methodology we have to use, how we have to evaluate. So there are certain parameters that we have given as to turnover, profits, track record, methodology, cost of capital. Because these are some of the challenges that we value, where we should take more cost of capital, where we should take less cost of capital, whether we should use discounted cash flow, whether we should use the book value, whether we should use income approach. So this slide will give you a fair idea of how and different, so this presentation will be circulated, so you can have a note of that. Third question that comes to my mind is there is a very question in, so valuation experts know this, but a general layman, industry people fail to understand that whether it is an equity value or it's an enterprise value. So when we value, then there are two things that are important, that which valuation methodology we are using and what is the result of that. Is it yielding equity value or is it resulting in the enterprise value? So that is one side. If we see the right hand side, value of business, another question that is important is that how to value intangibles. So there were certain discussions that was taking place, but the answer to that is important is that whatever is the business valuation, intangibles is a part of that valuation. So there are clients which say that you have done a net asset value or you have done a discounted cash flow, so that is my business value. But I have my distribution network, I have my brand, I have my HR. How to value that? So you add on a value to the value you have derived using a suitable method.